Before we start, let's begin with the company introduction. Aeon Company Malaysia Berhad is a leading name in Malaysia's retail industry. Its services range from department stores to e-commerce platforms, combining physical and digital shopping with its OMO approach. Guided by the philosophy of creating smiles and connecting hearts, Aeon prioritizes customer satisfaction, sustainability, and community values. Its vast network of 35 Aeon stores and 28 Aeon malls cements its dominance in the retail market. Next, let's move on to the importance of financial ratios. Financial ratios are crucial for analyzing a company's performance. They simplify complex financial data, making it easier to assess liquidity, profitability, and efficiency. Ratios enable both internal trend analysis and external benchmarking, helping stakeholders make informed decisions about investment and operations while evaluating how well resources are utilized. In this assignment, we focus on 3 tasks: analyzing Aeon's financial ratios to understand its performance, benchmarking it against industry standards to identify strengths and weaknesses, and providing actionable recommendations for improvement. These steps aim to enhance Aeon's performance and shareholder value.
I will explain about the usage of each category of ratio. Let's start with liquidity ratio. This ratio shows if a company can pay its short-term debts using its current asset. For examples include the current ratio and quick ratio. Next, we have debt ratio. This ratio measures how much debt a company uses and its ability to repay it. Key examples are the debt ratio and debt to equity ratio. Now, let's talk about asset management or efficiency ratio. This ratio checks how well a company uses its asset to generate income. For examples, inventory turnover and asset turnover ratio. Lastly, profitability ratio shows how well a company turns sales into profits. Examples include net profit margin, return on asset, and return on equity. Next, I will explain the company's financial performance in 2022 and 2023. First, the current ratio, it was 0.50 in 2022 and improved slightly to 0.51 in 2023. This shows a small improvement in the company's ability to cover short-term debts, but both years are still below 1, indicating the company does not have enough short-term assets to fully cover its liabilities. Next, the quick ratio. In 2022, it was 0.17 and it dropped to 0.14 in 2023. This shows the company is even less able to meet short-term obligations without relying on inventory. Both years are below 1, meaning the company doesn't have enough quick assets like cash to cover its short-term debts. Now, the debt ratio. In 2022, it was 66.70%, which decreased slightly to 64.41% in 2023. This indicates a reduction in the company's reliance on debt to finance its asset, which is a positive sign for its financial health. Next is the time interest earned ratio. It remained at 1.84 in both 2022 and 2023, showing that the company's ability to cover its interest expenses stayed steady, despite a decrease in earning and interest expenses. Moving on to the inventory turnover ratio. It improved from 6.84 in 2022 to 7.13 in 2023, suggesting that the company is managing its inventory more efficiently, possibly through increased sales or better inventory practices. The average collection period increased slightly from 7 days in 2022 to 8 days in 2023. This means it took the company a bit longer to collect payment from customers, indicating a slight decline in efficiency. Now, the total asset turnover. It improved from 0.76 in 2022 to 0.79 in 2023, showing that the company is using its assets more efficiently to generate sales. Next is the operating profit margin. It decreased from 5.11% in 2022 to 4.70% in 2023, suggesting a slight decline in operating profitability. This could be due to higher costs or lower operational efficiency. Finally, the net profit margin improved from 2.69% in 2022 to 7.78% in 2023, indicating better cost control. The return on asset also increased slightly from 2.05% to 2.20%, showing that the company is getting better at generating profit from its asset. Finally, the return on equity slightly decreased from 6.20% in 2022 to 6.18% in 2023. This shows that the company earned slightly less profit from the money invested by shareholders, but the change is very small, indicating stability in shareholder returns.
Moving on, we're going to talk about competitive analysis. First, Aeon current ratio stands at 0.51 times, which is significantly below the industry average of 1.58 times. This indicates that Aeon has less liquidity to cover its short-term obligation compared to its peers. A lower current ratio suggests challenges in managing working capital, likely due to a decline in cash and receivables. Alongside higher current liabilities, this weaker liquidity position raises concerns about Aeon's ability to navigate financial pressure in the short term. Next, Aeon quick ratio is 0.14 times, far below the industry average of 1.0 times. This highlights Aeon's reliance on inventory to cover liabilities, as it lacks sufficient liquid assets like cash or receivables. This creates additional liquidity risk, especially in unpredictable market conditions. Improving this ratio should be priority for Aeon to ensure stronger financials. Now, let's talk about positive highlight. Aeon's inventory turnover ratio is an impressive 7.13 times, significantly outperforming the industry average of 1.0 times. This indicates that Aeon is selling and replacing inventory much faster than its competitors. Efficient inventory management like this reduces holding costs, improves cash flow, and enhances overall operational efficiency. Moving on to the debt ratio. Aeon stands at 64.41%, which is lower than the industry average of 75.3%. This demonstrates a more conservative approach to leveraging debt. A lower debt ratio reduces financial risk and strengthens Aeon's ability to weather economic challenges such as rising interest rates or downturns in the market. However, Aeon net profit margin is only 2.78%, significantly below the industry average of 6.16%. This reflects challenges in cost control and profitability. Aeon may need to address higher operating costs or pricing pressures to improve its ability to convert revenue into profit. This will be critical for long-term competitiveness. Last but not least, Aeon shines in its return on equity, which is 6.18%, higher than the industry average of 5.25%. This demonstrates Aeon's ability to generate more profit from shareholders' equity compared to its peers. Despite challenges in liquidity and profitability, Aeon's efficient use of equity capital creates strong value for its shareholders.
Aeon has made commendable progress in its financial performance, showcasing its traits while also identifying areas for improvement. Let's take a closer look. One of Aeon's key traits is its improved debt management. In 2023, its debt ratio decreased from 66.70% to 64.41% in 2022. This means the company is reducing its reliance on borrowed funds, lowering financial risk, and enhancing its stability. Aeon also delivers strong returns for its shareholders. Its return on equity, or ROE, stood at 6.18% in 2023, outperforming the industry average. This shows the company's efficiency in using shareholder investments to generate profit. Another area where Aeon excels is inventory turnover. In 2023, the ratio improved to 7.13 times, up from 6.84 times the previous year. Faster product sales mean a more consistent cash flow, supporting smooth operation. Despite these trends, Aeon faces several challenges. Its liquidity is a concern, with a current ratio of 0.51 times and a quick ratio of 0.14 times. Both figures are significantly below the industry standard, which could make it harder to cover short-term financial obligations. The company's operating profit margin has also declined, dropping from 5.11% in 2022 to 4.70% in 2023. This indicates rising costs or reduced operational efficiency, both of which can impact profitability. Finally, while Aeon's inventory turnover has improved, it remains slightly below the industry average of 7.1 times. Additionally, the total assets turnover ratio of 0.79 times suggests Aeon could better utilize its assets to generate revenue. To address these challenges and build on its strengths, Aeon could consider the following strategies. The first one is improve liquidity. Aeon can increase its cash reserves by reducing unnecessary expenses and negotiating longer payment terms with suppliers. It could also explore short-term loans to handle immediate financial needs more effectively. The second one is boost profit margins. The company can lower costs by automating tasks and adopting more efficient technologies. Negotiating better deals with suppliers and focusing on high-margin products can also help enhance profitability. The third one is enhanced asset utilization. Aeon should review its underperforming assets and allocate resources to areas with higher revenue potential. Modernizing store layouts and offering trendy products can attract more customers. The fourth one is optimized inventory management. Adopting systems like just-in-time inventory management can minimize excess stock and reduce costs. Accurate demand forecasting through advanced technology will ensure Aeon stocks the right products at the right time. The fifth one is strengthen marketing efforts. Targeted marketing campaigns, loyalty programs, and an improved online shopping experience can help expand Aeon's customer base and drive sales. And lastly, the sixth one is reduce debt further. By continuing to pay off debts using profits and refinancing loans for better interest rates, Aeon can further reduce financial pressure. Aeon has already demonstrated resilience and progress. By addressing its challenges strategically, it can continue to grow, ensuring long-term success and value for its shareholders. In conclusion, Aeon Company Malaysia Berhad has shown strength in managing its debt, reducing its debt ratio to 64.41% and delivering a strong return on equity of 6.18%, outperforming the industry average. Its cash flow remains steady thanks to efficient receivables management. However, challenges persist, particularly with liquidity, as its current and quick ratios fall below industry standards. Aeon also struggled with inventory turnover and a declining operating profit margin. To address these, Aeon can build cash reserves, adopt just-in-time inventory systems, and refresh store layouts while growing its e-commerce and sustainability efforts. By leveraging its strengths and tackling weaknesses, Aeon is well positioned for sustainable growth in retail sector.